Ever look at the stock market and just think, is this whole thing just a giant, fancy casino? I mean, it's a totally fair question, right? You see stories of people building massive fortunes, and then you hear about others who lose absolutely everything. So today, we are going to settle this once and for all. We're breaking down the real difference between smart investing and, well, just pure gambling. The goal? To help you understand how to actually build wealth, not just toss your money on the table and hope for the best.
All right, let's just dive right in. Is the stock market the smartest way to grow your money, or is it just a high-stakes game of chance with a fancy dress code? The honest truth? It can be either one, and it all, and I mean all, comes down to how you approach it. Okay, so the biggest, most fundamental difference really boils down to one simple question. Are you buying a little piece of a real, actual business, or are you just placing a bet on a random outcome? That's it. That is the core idea that separates a true investor from a gambler.
You see, when you buy a stock, you're not just buying some random ticker symbol on a screen. You are buying a small slice of a real company. Yeah, think Apple, or even that awesome local pizza shop on the corner. Now, if that business does well, if it grows and makes more money, guess what? The value of your slice, your little piece of the pie, grows right along with it. You're not just a spectator, you're an owner.
So let's put these two side by side. On one hand, you have investing. Your decision is based on a real, productive business that you can actually research and analyze. You have some control, and your biggest ally? It's time. On the other hand, you have gambling. It's just a bet on a short-term, mostly random outcome. You have practically zero control, and the math is literally stacked against you. The house always has the advantage in the long run.
Okay, so that's the theory, right? Ownership versus a bet. But what do the actual numbers say? Well, history shows us a very, very clear winner when you compare these two.
Take a look at this number. Roughly 10%. That's the average annual return of the S&P 500, which is basically a basket of the 500 biggest companies in the US over the long haul. Now, is that a guarantee for any single year? Absolutely not. But it's an incredibly powerful sign of the market's tendency to grow over time. Why? Because it reflects real economic growth, real innovation, and real profits from actual businesses.
And if you want to see what that looks like, here it is. Investing in the market has what we call a positive expected return. You're essentially betting on the long-term growth of the economy. Gambling, on the other hand, is specifically designed to have a negative return for you, the player. Every single game in a casino has a house edge. That's a built-in mathematical advantage that guarantees, over time, the house wins.
So what does that actually mean for your wallet? Well, let's say you invested $1,000 and it grew at that historical average. In 10 years, that could turn into more than $2,500. Now, if you took that same $1,000 to the casino, sure, you might get lucky once, but the cold, hard math says you're most likely to walk away with nothing. See the difference? One path slowly builds wealth. The other one destroys it pretty quickly.
Okay, now here's where we need to get really honest. It is absolutely possible to treat the stock market like a casino. And this is the part that trips so many people up. The problem isn't the market itself, it's the approach you take. It's how you decide to play the game.
And this right here is exactly why there's so much confusion. The stock market can feel like gambling, but only if you treat it that way. If your whole strategy is about getting rich quick, chasing some hot tip you saw online, and betting on rumors, then yeah, you've officially turned investing into a total gamble. You've ditched the idea of ownership and analysis for the cheap thrill of a short-term bet.
So, does any of this sound familiar? This is the gambler's mindset in action. Chasing that quick money, right? Following social media hype and buying some random stock you know nothing about, just because everyone's talking about it. And then the big one, panicking and selling the second prices go down. Let's be clear, this isn't investing. This is just guessing, and it is a surefire recipe for losing your money.
All right, so if that's the wrong way to do it, what's the right way? Well, the good news is the playbook for being a smart, successful investor is actually pretty straightforward. It's not about some hidden secret. It's all about discipline.
Really, it all comes down to 5 simple but super powerful steps. First, invest in strong companies, or, even easier, broad market index funds. That just means you're buying a tiny piece of all the big companies at once. Step 2, think long-term. We're talking years, not days or weeks. Give your investments time to breathe and grow. Third, be consistent. Invest regularly, maybe every single month. That's how you build your position over time. Fourth, and honestly, this is the hardest one for most people, do not panic when the market drops. Stay the course. And finally, number 5, keep learning and be patient. This simple, almost boring approach is incredibly effective.
So when you boil it all down, you're standing at a fork in the road. You're faced with a choice. The market itself is just a tool. It doesn't change, but your approach, your mindset, that determines which path you're going to walk down. And here's a final crucial piece of investor psychology for you. Smart investors, they don't fear market drops. You know what they see? They see opportunities. When the market goes down, a gambler panics. They sell. They lock in their losses. A smart investor, they understand that everything is just on sale. They see a market drop not as a crisis, but as a chance to buy more of those great businesses at a discount, all while staying focused on that long-term goal.
And here are the results of those two different paths, laid out plain and simple. The investor? They build growth. They build real, lasting wealth, and they work towards financial freedom. The gambler? They find losses, frustration, and a ton of stress. And you know what often happens? They quit right before things might have turned around, missing out on all the future growth. It's the exact same market, but the outcomes, they could not be more different.
So if there's one thing you take away from all this, let it be this. The stock market is not, by itself, gambling. It only becomes gambling when you, the person putting the money in, don't understand it. When you act without a plan. The power to decide which it is, that's all on you.
So, the real question here isn't about the market at all. It's about you. Are you truly investing? Or are you just placing a bet and hoping for the best? The choice, and the results that come with it, is entirely yours.